Mike Larson for Money and Markets TV. Ben Bernanke and his cohorts of the Federal Reserve keep telling us that their unprecedented money printing is aimed at helping mainstream America. And by driving down interest rates, they are making homes and cars cheaper for consumers to buy. But this interest rate medicine is now causing a dangerous side effect. It's actually sickening U.S. banks and threatening to make it harder to obtain credit. You see, ultra-low interest rates are driving down the bank's net interest margin, or NIM. That's the difference between what banks pay out in interest on deposits and what they earn in interest on loans or investments. The wider that margin, the more profitable a bank's core lending and deposit-taking operation is. And the more profitable a bank's core operations are, the more willing it is to loan out that money and the more risk it's willing to take on. But because the Fed has slashed short-term rates to within a few basis points of 0%, yields on many bank accounts have also gone about as low as they can. In other words, bank input costs are incredibly low. Meanwhile, the Fed is aggressively suppressing rates on long-term investments and loans as well. Those include mortgages, mortgage-backed securities, corporate debt, and more. That means that as each old loan matures, or each old investment is paid off and retired, the bank has to make a new loan at a lower rate, or buy a new security that yields less. Each unit of bank output is therefore generating less revenue. As a result, NIMs have collapsed from nearly 4% to just above 3.1% at the nation's largest banks. SNL Financial says that's the lowest level in 3 years. And the problem is systemic. Profit margins at 79% of the banks tracked by Keefe, Bruyette & Woods fell in the third quarter. Now, as a result, stock prices at many regional and super-regional banks are starting to break down. For example, BB&T shares have dropped nearly 15% in about a month. Regions Financial, PNC Financial, and Wells Fargo are also starting to slip. Now keep in mind, financials were previously the prime beneficiaries of the cheap money trade, but now they may be becoming its prime victims. If that's the case, the broad market could be in big trouble. After all, stocks are already under pressure due to lousy earnings in technology, industrials, and materials. But it's not just the stock market that's in danger. There's also the overall economic impact to consider. The Fed thinks it's helping by driving down rates and bond yields. But just like with any patient, at some point, too much medicine becomes toxic rather than helpful. If banks can't make money making loans and investing excess funds, they're going to scale back their lending and they're going to take on less risk. That will make an already tight mortgage market even tighter and constrict the flow of credit to businesses large and small. And that could have a major impact well beyond the financial sector. I'm Mike Larson for Money and Markets TV. Thanks for watching.